let's just get the global out of the way as always. Matt Orton is Chief Market Strategist at Carillon Tower Advisers. He's with us. Thanks very much, Matt. It's always a pleasure. Great to have you with us here. This morning, this news flow on... I wanted to ask you if you're an Apple or Android fellow, but I wouldn't go there. We already had a bit of a... but Apple is...
I've got the AirPods in, so
AirPods,
I think that's an indication.
Yes,
That's true. That's true. Matt, so Apple this morning saying that, they're going to sort of ditch the iPhone production increase because demand, according to them, is faltering a bit. And Asian markets are seeing a fresh leg lower. This is adding to a long list of commentary we've heard from companies, large companies in the U.S., sort of talking about concerns around demand. How would you read this and implications for markets?
Good morning. Great to see you, Prashant. It's hard to get too negative on whatever this headline is. I think Apple is getting in front of perhaps what might be a little bit more of a challenging earnings season. And to what you were alluding to before, the demand for the new phone, they have to come out with the new phone on the standard cycles that they usually do. What that means for the ultimate, purchasing power of the phone, the impact on margin, it's really hard to tell. I don't think we can take any reads to the broader U.S. consumer from this, because the data that we continue to get in real time is supportive of the consumer. It's supportive of the U.S. economy. So it's an anecdote. The market likes to feed off of negative news, so it's certainly a negative catalyst for where we're heading for the next day. But I don't think it's indicative of a trend or anything that is going to be catastrophic for Apple or the broader market.
Matt, good morning. But the market action anyway has been looking catastrophic, right? It's broken the June lows except for the Nasdaq, and the dollar is inching higher and higher. Something we haven't seen in the last decade or so, ever since the GFC, right? So for a lot of people who have been first-time investors, this has come as a bit of a shock. They don't know what to do. What's your view? How much lower for the market from here?
And the pain, isn't even in the equity markets, it's in the fixed income markets too. And I talk to a lot of our clients who have diversified portfolios. It hasn't even, we've had a near historic bad start to the year in the equity market, but fixed income has had an equally bad start to the year. And it's in regular yield is painful, and in real yields, 10-year real yields in the US are now north of 1.6%. That has been a big weight on equity markets, on valuation compression, and it's really hard to see a light at the end of the tunnel until we know when rates are going to peak. And I think the big problem I had with last week was that during the Fed press conference, we basically managed to out-hawk the hawks. It was very, very challenging to hear that we're still going to have 75 basis points more in November, perhaps 75 more basis points in December, and then a cherry on top of 25 more in January. I'm not sure that's necessary. Inflation is starting to come down in the US. So the impact on equity markets and fixed income is still a challenging picture. And that's why when I talk to clients, it's all about leaning into quality, having companies that have higher ROE, that are actually generating cash, paying dividends and growing their dividends. And I think that can be applied to all markets around the world, because quality is working, lower beta is working on these sorts of downside moves. So you want to remain defensive right now.
That argument is fair, but somehow it's not working out in our own markets. You're saying that lean into quality stocks, into companies that have a high growth trajectory and perhaps have their balance sheet intact. Case in point for us is the IT sector, right? These companies are best in class worldwide, but now these stocks are down about 30-40% from their peaks, perhaps because of the margin pressures, the impending recession across the globe. Be that as it may, do you think that this is a good time to perhaps enter into some of these beaten down pockets like the tech sector, in the Indian markets particularly?
I do. I think in the Indian markets, information technology has actually held up a little bit better on a relative basis over the past week or two. IT services has been more of a bright spot. And to your point, when you look at where global spend is around corporations, it's investing in better technology infrastructure. And a lot of the companies that are heavier weights in the Indian technology market are providing services to global technology companies, to global services companies that need these technologies. So I would say that the weakness that we've been seeing year to date is definitely an opportunity for longer term investors. There could definitely be more pain in the short term because it's going to trade with the beta of the market. But when you do start to see the market trade more on fundamentals, we're heading into an earnings season. Positive numbers, I think, could be a catalyst for investors to say, enough is enough. It's been discounted enough for me to start to dip my toes in. And I think for those who are willing to play the longer term game, it's a good time, especially in India, to start accumulating information technology.
I think that's a very good point. That's one large group of stocks here which is substantially lower. It's not participated in the rebound generally. Overall, Matt, you know, there have been some who've come on the program these are U.S. Market commentators, etc., who say that, you know, this time of the year, September, October, is usually when things kind of can get a little tricky. You know, because you're kind of looking at the end of the year, but a lot of the problems that you started the year with have not gone away. Next year is still looking a little. I mean, people kind of start to throw their hands up in despair. So you get these, mini accidents. Anything in the market out there would suggest that? You mentioned bond markets. You know, I was reading yesterday that U.S. Treasury market liquidity is actually just completely collapsed. You have many other indicators which are flashing red. Any thoughts on that, Matt?
The liquidity situation is a problem. From speaking with some of our traders at our firm, where we have a pretty diversified fixed income franchise in both treasuries and credit, and it's not a challenge to get the issues that we want or to make the trades we want on behalf of our clients, but liquidity is a problem for the overall market. I don't think we're anywhere near the point where something's actually going to break and that creates an even larger market event. We're still far away from that, but liquidity is a problem. And even in the equity markets, when you go further down the market cap spectrum in the small cap space, you know, bid offer spreads are wider than they tend to be. And I think it's just a reflection of negative investor sentiment. And there just being a broader reticence to want to put money to work. It's really hard to jump in front of the truck per se and not know if it's going to stop for you. And I think that's the problem that a lot of investors have. But like I said before, for those who are willing to play the longer game and to build a more diversified portfolio, this is actually a good time. We're moving yields to a more normal level. I mean, we forget the past 10, 12 years of easy monetary policy around the world is not normal. We had $18 trillion of negative yielding debt around the world, and most of that's gone. The pace at which that has happened has been very, very uncomfortable to a lot of investors, and especially first-time investors. But to be able to get 4% on, 4% plus on a 2-year treasury yield in the U.S., being able to get high-quality corporate bonds at 5-6% and get equity valuations right now, the S&P 500, 16.5, 17 times forward earnings, that's pretty good to set up a diversified portfolio for the longer term. And the key to manage some of the short-term pain is to be very tactical with your asset allocations. And that's what we're advising to clients. And even in global portfolios too, leaning out of Europe, leaning more into India and Latin America, like we've talked about in the past, I think that still makes a lot of sense.
You literally snatched my next question, but I'll still ask it. What's happening in Europe? You had the UK where clearly things are, almost looking like collapsing. In Italy, we have now a right-wing government where, and again, that talks about some kind of collision with the EU. So do you reckon the more money will flow out of EU from here on to other asset classes?
I do think so. Europe right now, to me, is not very attractive. And I'd say there's much better opportunities around the rest of the world, unless you're, there's of course going to be single companies that are attractive, but as a whole, it's hard. And it's the inflation problem. Europe right now is importing inflation. It depends more on China, where there's still COVID lockdowns for a lot of their imports. They import most of their energy, which is clearly an issue with what's happening in Russia and Ukraine, and energy prices are still elevated, and we're heading into winter. So what you're seeing in Italy is, I think, a reflection of public discomfort with inflation. What we saw happen in the UK is a direct response to not being able to deal with inflation, to keep the consumer afloat. And you don't have the same degree of those challenges in other regions of the world. So I think on a tactical basis, even though Europe is cheap, I wouldn't want to catch that falling knife right now.
Okay, wouldn't want to catch the falling knife, especially in markets like Europe. So perhaps investors sticking to or leaning towards markets like India and Latin America, as you said, right? Thanks a lot, Matt, for joining in, and have a great day. That's the word coming in from our equity expert globally. Let's take a quick break. On the other side of the break, our entire team will be with us to help us with the list of top 10 stocks. Stay tuned.